So let's kick off. So good morning, everyone, and thank you for joining us today. I'm Jonathan Skinner, a partner here at Acuity, where I spend a good amount of my time helping businesses like yours navigate through your exit journeys. So I'm delighted to welcome you to this webinar today, where we're focusing on this very topic of exit strategies. So while most SME businesses don't start a business thinking about maybe how one day they're going to leave it, but whether that's 5 years or 20 years, your eventual exit is likely to be one of the most significant and probably complex financial events of your life. In today's session, then, we're going to talk about and help you understand a little bit more about this landscape of exit options, what they look like, how they work, and how you can prepare to get the best outcome for you financially and personally. We'll cut through the massive sea of jargon and misconceptions that plague this topic and give you some real-world insights. Now, whether you're thinking about selling to a third party, handing over to a management team, or some form of employee ownership option, we want to leave you clearer on your options and, more critically, on your next steps. I'm going to hand over to my colleague Dan shortly, where he'll run through an exit, covering initially what we mean by exit, so cutting through some of that jargon. He'll run through the most common exit routes: MBOs, trade sales, employee options, liquidations. And most importantly, we'll end on a discussion on what you should be doing today to plan and prepare for your exit. So Dan, over to you.
Well, thanks, John. So jumping in, first of all, just start by unpacking what are we talking about when we say exit, okay, and tackling some of the most common misconceptions around what people think an exit means. Okay, so first of all, as you can see on screen, an exit is any transaction where you sell ownership of your company. Okay, now what I think it's important to emphasize here is that an exit doesn't just mean selling your company to another company, which is commonly one of the things we hear from the business owners that we work with. Okay, now hopefully, as we'll cover a bit more in the rest of this session, there's a much broader spectrum of options out there than just trade sale. Okay, there's management buyouts, there's liquidating your company, and there's the increasingly popular world of employee ownership trusts, which we'll unpack in a little bit of detail, but not too much detail later. Okay, I think the two things that it's worth just unpacking a little bit more here are two key points, really. So first of all, we like to emphasize this point that exiting your business is a process, not a single event, and really planning ahead of time to think about what's important to you, both financially, personally, and the legacy that you want to leave behind in your business is really important to think about ahead of time, rather than just being at this point where I'm ready to sell now. How do I go about doing it? Cool. Okay. So just recapping then, what are the most common exit routes for SME business owners? Okay, now, whilst yes, selling your company to another business or another company isn't the only route, it's still a very common one. Okay, so we'll be unpacking that in a bit more detail shortly and running through what that process looks like. Management buyout. So this is where your existing leadership team or management team takes control of the business from you and buys you out. Okay, and again, there are some myths and misconceptions around what that is and what that looks like that we'll go through in a bit of detail. And this new and increasingly popular world of employee ownership trusts, where in effect you are selling your company to a trust that owns the business on behalf of all employees. So all employees become de facto owners of the business, whilst the management team, the existing management team, will continue to manage that business in exactly the same way. Okay, and then finally, we'll just touch on quickly liquidation. So that's basically closing down your business, liquidating all of its assets, selling off all its assets, and winding the company up. Which is we'll talk a little bit more later, is normally an option of last resort, but can be appropriate in the right set of circumstances. Okay. So what does a trade sale journey really look like? Okay, so this is again where you're selling your company to another third party or another third party company. Another company comes along and acquires your company. Okay, now the first thing I think is just worth emphasizing here, at least from our experience, is that these transactions can take a long time. Right? We have seen some transactions as quick as 3 or 4 months, but more typically these processes take 9-12 months upwards. And even then, once the transaction's executed, it's normally unlikely that a buyer or another company that's acquiring you is happy just to let you sail off into the sunset as soon as they take over. Normally, they want to keep you around for a period of time after the business has been sold to ensure they can hand over certain relationships and certain employee journeys are looked after and things like that. So really, this process of selling your business to another company can take quite a long time, can take a couple of years in some instances. And there are a few common areas where we see these deals drag out. So just sort of starting with the process as a whole, right? Unlike some of the other processes that we'll talk about in a bit more detail, some of the other exit routes rather that we'll talk about in a bit more detail, really once you sort of get into negotiating and once you get into having conversations with a buyer about acquiring you, they're in control. So they can drag that process out as long as they like, whether that be with extensive due diligence and asking tons and tons of questions about all of your contracts and all of your employees, all the detail in the world about every document of the business, whether that be to do with their own financing challenges. So again, making sure they have the funding in place to acquire you and pay you the consideration. And again, we've seen deals drag on 18 months, 12 months, in fact, for that very reason, financing the deal. And then again, just sort of as the buyer's in control, there's always a risk, again, unfortunately, as we've seen before, of the deal collapsing altogether. So you can get sort of 12 months down the line of this process and suddenly the buyer walks away. They've got full control over the process here. So yeah, just recapping, I think one of the things to emphasize that's a common misconception around selling your business to a third party company is just the length of time that this process can take for many businesses.
Just also to add in there as well, I think the other misconception we see on is that these are straightforward transactions, and certainly one of the key takeaways of doing many trade sales is the mental toll that it takes on all the parties involved. By the end of the journey, start the journey, everyone's friends. By the end of the journey, everyone's ready to leave the room fairly quickly. You've got two sets of lawyers arguing over a pile of large documents. You've got large numbers moving around a lot, and a deal that typically is the only deal that you'll do in a lifetime like this. At the end of all that, the mental toll is very real.
Yeah, and actually, just another point on that as well around the valuation, and we'll come on to talk about that a little bit more detail later. But it's usually uncommon that a buyer will go, here you go, here's the full value of the business day one. Again, that point around you sticking around in the business for a period of time, it's normally linked to a chunk of the consideration. So something 60-70% is typically what you might see up front. And again, the sort of earn out period, or the period where you're still beholden to the business, you might see the other 15 to 30% trapped whilst you're still in relationship with the business. Cool. Okay, so moving on to management buyout. So again, just to recap here, a management buyout is where the company's existing leadership team is buying out the current shareholders of the business, and again, taking on responsibility for managing the business day to day. Now, one of the common things we hear here about management buyouts and sort of why they're not palatable to some people is this view that people believe in order to enact a management buyout, you need big amounts of external private equity or big bank funding to come along and be the driving force behind financing the deal. And whilst that does happen, particularly in larger companies, it's not common for private equity to be the sole driving force behind financing smaller deals in the SME space. What is more common is that where these transactions work most effectively at the SME level, again, it's unlikely the management team are going to have full consideration day one to buy you out as an exiting shareholder. But this use of vendor loan notes, or effectively an IOU, from the sellers, means that the business can pay out the exiting shareholder from future profits. So the seller walks away, perhaps receiving all of the free cash or excess cash that sits in the business, and gets paid the remainder of their consideration over time, from future profits of the company. Okay. And just stepping into quite a little bit more colour to how this is one example perhaps of how these transactions often work. So the management team might form a new company, a holding company, if you like, which is this orange square over here. Okay. This company then acquires the shares of your existing business, okay, from the shareholder. And again, the cash from the company is used to pay out large parts of the consideration over time. Okay. Now, what does an MBO look like from the seller's perspective, and what things should they be thinking about when going along an MBO journey? Okay, so I think the first thing, really, just to recap, is if you're thinking about a management buyout, or you have a leadership team within your business for which this might be appropriate, really assessing appetite is the first stage here. So, is this something that they're interested in? Do they have the capability, and do they have the ability to take over running the business from you on a day-to-day level? Are they willing and committed to the business over the long term? Because again, in many instances, these transactions take a couple of years to finance properly. At least, are they motivated to continue the business in the right way? Okay, and then we step into really understanding how much the business is worth. And again, we'll touch on this more as we go through, but this is a really important question for every different exit route, but not least, right, with a management buyout, where we're trying to understand how the deal might be financed. Are the management team going to put any skin in the game? Are we talking about a 2-3 year exit journey where you're going to be paid out from the company's profits over time? And understanding at this stage as well what the risk profile of that looks like to you. Are you happy stepping away from the business and having the confidence the business will be able to pay you your deferred consideration, or are the leadership team not going to be capable of kind of delivering that, and trusting the business will be in safe hands, as it were? Okay. It is worth saying at this stage as well that whilst big private equity money is again not that common at the SME level, we do often see smaller amounts of bank financing, asset financing, or something equivalent, being used to kind of accelerate the day one consideration that a seller might receive. So any financing that the business can raise in general helps fund day one consideration. And there are some lenders, specialist lenders out there, who are quite familiar with financing these sorts of transactions at a smaller level. And that can be a useful tool. So during the deal structuring stage, we might be looking at that, investigating that, to see whether that can help fund the transaction in the right way. Okay.
It's worth adding in as well is, so for these sorts of structures, we've had a lot of success of using them for family businesses doing succession between generations as well, where in this most simplest form, some parents could hand down some shares to some children to take over the running business in the future. But it can also work where the parents, instead of handing down the shares to the children in the future, actually have their shares acquired by the children, but funded by the company. Okay, so effectively you kind of get to have your cake and eat it. You get to hand some shares down to the next generation without them, let's say, having to pay for it. But you get the money that you've built up in the company over time, and get those at capital gains rates as well, which can be very favourable. Less favourable now than maybe perhaps a year ago, but yeah, that's worth noting. We've seen that be successful time and time again for family succession planning down generations and families.
Yeah, absolutely. So stages 4 and 5 here really are about the execution of the transaction. So, as we touched on the last slides, when we're executing these transactions, there's a bit of structuring work that needs to happen, and legal paperwork and tax planning and things that need to be set up in order to facilitate these transactions. So making sure we have new entities set up, making sure there's share purchase agreements and things in place, and getting any clearances that might be required from HMRC ahead of time, so that's all ready to go when we complete the transaction. And then again, stage 5 being completion, and again a handover process normally where management team is sticking around on some sort of informal basis. Sorry, the sellers rather are staying around on some sort of informal basis to make sure the business is looked after and can continue running smoothly post the shareholder exiting. Okay, I think last thing just to mention on this slide is timeline. So again, compared with the trade sale route, for the most part here, and particularly because all the parties here are known to one another, the timeline for these sorts of processes are normally much shorter. Again, if there's external financing or if there's any debt being raised, that can add some delays, but we're typically looking between 3 to 6 months for executing these transactions. Again, understanding there might be a tail of payout of the company being paid out over time from future profits, but the actual transaction execution can happen within a relatively short time frame, certainly when compared to a trade sale. Okay, so now just spending a bit of time talking about employee ownership trusts. Now, I think the first thing to be said here is this is quite a big topic, and we could easily spend an hour talking about this in its entirety. But what I'm hopefully going to achieve here is just recap some of the key things about what we mean when we talk about an employee ownership trust, and go through again why this is becoming an increasingly popular exit route for owners of private companies or SMEs. Okay, so when we say exit to employee ownership trust, what in effect we're saying is that the shareholder sells their shares to a trust that's set up to hold them on behalf of all of the employees. So in effect, all of the employees become equal owners of the business. Okay. Now, that doesn't mean that anything necessarily changes from a day-to-day running of the business perspective. The existing management team still take control of running the business and still run the business in the same ways they always have. Okay. Again, you might want to empower some of those management team or some leaders within the business already to step up and take on more responsibility, but really they are not the owners, they're the management team, and they're taking responsibility of managing the business, and the employees as a whole become owners of the business. Okay. So this is sort of again a newer transaction route that's been kind of popularized. It's been around since about 2014, but popularized particularly in the last 4 or 5 years. And again, this is another exit route where predominantly the owner is paid out from the future company profits. Again, they can raise external finance in the business day one that will help accelerate the amount of cash you might receive day one, but the predominant amount of consideration is going to be paid from the future profits of the company. So again, just stepping through very, very briefly what this transaction might look like. So again, you've got an employee ownership trust or EOT in the middle there, with which a shareholder is selling a greater than 50% proportion of their holdings to the employee ownership trusts, which holds the shares for all employees. And again, the EOT is funded by the company. So again, cash is paid from the company's profits to the shareholder over time, including any free cash day one that can go to the shareholders, and future profits of the company funding the rest of the consideration. Okay. So what are the key reasons why this is becoming an increasingly popular route? Well, number one there, as everyone can see, these employee ownership trust transactions, when qualifying and meeting all the right criteria, attract a 0% rate of capital gains tax. Okay, where in a landscape, as we've seen, capital gains rate taxes change so much in the last 6 to 12 months. These capital gains tax rates are now 24% at the headline rate. So for many businesses, the valuation from a trade sale route has to be in effect 24% higher in order to be equal to the net outcome that a shareholder might expect from an employee ownership trust versus like a trade sale. Okay. Another key reason, again, as we touched on with a trade sale, the timeline can be extremely drawn out because the buyer remains in control of the process. Whereas with an employee ownership trust exit, you are selling your company and you're effectively giving the shares to the trust for the benefit of all employees. So you have full control over that process the entire way. It's also increasingly popular because many business owners expressing that they really deeply care about what happens to their business post sale or post exit, and more pertinently, so in a employee ownership trust or EOT exit, much of the business's culture and much of how the business operates stays the same immediately post exit. So the exiting shareholder gets to feel like the business they've built remains intact, and they're very much just stepping away and allowing the business to continue doing exactly what it's doing, grow and be nurtured by the existing management team. Okay. There are also some incentivizations for employees in EOT. So business owners can incentivize their staff with these tax-free bonuses of about 3.6k a year, which does a couple of things. One, helps fuel this culture-led organization of everybody feeling like they are and are in fact owners of the business. So helping everybody feel motivated to drive the business forward in the right direction. And secondly, gives employee ownership trust run businesses or EOT run businesses this ability to compete better with other non-EOT owned businesses. So again, if your competitors who are non-EOT owned have to, or were going to offer the same thing, they would have to up the bonus in order to deliver the same outcome, because 3.6k goes tax free in the bonuses that you choose to award to employees within EOTs, whereas within other companies they would have to pay tax on that. Okay.
It's also just an observation here that we've seen across transactions we're leading in our client base is that through the difference in tax rates from a trade sale versus an EOT, so 24% versus 0%, and certainly in the difference in how the process is run, trade sale, you lose a lot of control through handing it over to a buyer through the process. EOT, you're almost fully in control of the timeline, how you run the whole process. With the joining of both of those, it's common that we're finding, surprising, that the EOT is actually the optimal route for a lot of businesses, where either historically or the kind of common sort of knowledge might be the trade sale reaches best outcome for valuation for the business owner. This is becoming less true now, particularly as the advisor space knows how to use EOTs even better than they did 10 years ago and how to apply it. The speed of transaction is really high. Banks' availability to fund transactions to get more money day one on EOTs. EOTs, as you can see from the numbers of increased uptake, are becoming more and more popular. What we're also seeing happen, and we're doing more and more, is you might be taking a business through a trade sale, but you run in parallel almost an EOT process, so that the EOT becomes one of the prospective buyers in the competitive landscape that you're trying to create for bidders for your business. So you might have 3 actual other businesses bidding to buy your business, and we can add to that now the EOT. And those 3 bidders have to beat the outcome that the EOT can provide for your business, which is a good way for boosting valuation and also for speeding timeline of deal.
Yeah, cool, exactly that. And again, that's pretty current on at least a couple of transactions that John and I are working on right now. That EOT being a stalking horse, if you like, whilst having conversations with potential buyers. Cool. Okay, so just touching on briefly then the final option that we outlined at the start around liquidating your company, okay, or closing down your company and winding the company up. So I think the first thing, just to reiterate here, is that certainly when you benchmark it against other exit routes like trade sale or like management buyout, normally the valuation is suppressed when you're talking about liquidating your company. Okay, and the main reason for that being a buyer is buying, a trading asset off of you, and that includes things like the value of any brand associated with your business and trading name and reputation associated with it. Whereas when you are liquidating your company and closing it down, quite simply, you're selling off all of the assets that are owned on your balance sheet and trying to get as much money for them as you can. And again, depending on the timing of your process, if you have assets that are worth a certain amount, you may have to accept slightly below market value in order to sell them today or sell them currently. So selling off your assets, paying off all of your liabilities is in effect what you're doing when you're closing down your company. And any intangible value, so again, brand and reputation and things like that, are often completely overlooked, get missed out entirely when talking about what your business is worth. Okay. The second thing was just more of a kind of word of caution here to anybody who's thinking about this being the right exit route for them, is the tax rules around this are quite nuanced, and there's some specific anti-avoidance rules and things like that, which mean that you're not guaranteed to get the same capital gains tax treatment as you are with trade sale or management buyouts. And in effect, if it's not capital gains, it falls under income tax, which can be high at much higher rates, depending on, again, the amounts we're talking about here. And again, so having the right advice and having the right people involved in setting this liquidation up for you is quite important. You can, again, the specific tax planning and insolvency advice or to get these companies wound up properly, that again can be quite expensive, and it's not quite as simple as just saying, right, okay, I'm done. I want to stop trading now and I can close my company up tomorrow. Often it's a little bit more complex than that, for the reasons you can see on screen.
So just quickly on the tax
Yeah,
implications, one of the common misconceptions or questions that we might get for a business considering just winding things up and closing and taking the money, is the assumption that you automatically get access to the business asset disposal relief, the 0% rate of capital gains for trading businesses, which is diminishing and disappearing over time anyway. But that's not necessarily automatic in these cases, and that's often to do with the technical definition of your business once it's closing, whether it's a trading business or investment business. Right, so if it's got lots of cash and not trading, there's the danger of becoming an investment business and not getting access to the release that you think or assumed that you will. Okay, so I think like Dan's saying is you do need advice early on in the process. Don't make big assumptions, and you probably need, in most cases where there's significant value here, to going insolvency practitioner route to do some form of CVO MVL type route.
Yeah. Cool. Okay, so what we wanted just to do here then was just to distill down, I think, some of the key messages around planning and preparing for exit. As John touched on earlier, selling your business, selling your company is often one of the most important transactions that any individual might go through, particularly if you're a business owner. And I think what we want to do here is just recap our kind of, or distill our advice into these 3 or 4 buckets that we can see on screen here. So number one, as we've been hopefully emphasizing as we go through, exit or exit planning is very much a process, and we shouldn't see exit as a single event. So the importance of starting early and planning out what the right exit looks like for you and what things are important to you, outside of value in particular, of understanding business value is a whole other topic again that we can spend a fair bit of time talking about. But outside of value, do you care about, or to what extent do you care about the state of the business after you leave it, the business's future, employees' future, etc., things like that. So designing the right exit is much more than just about valuation. It's about about your own personal circumstances and what you want to happen to the business after you leave. Okay. And again, touching on the valuation topic, again, it's one of the most common starting places for planning for exit. Is really making sure you understand what your business is worth and understand how you can maximize your valuation as well. So, we hear lots of businesses businesses and business owners who come to us and say, "Well, I've been told my business is 6 times profits or 6 times earnings," and whilst some valuation metrics are based around a multiple of earnings, it's often not quite as simple as just X times profit is what your business is worth, and there are often there's often things going on within certain markets that drive or suppress valuation. So again, understanding what the current market sentiment is to your business and to your market, and what things are maximizing valuation and what things are suppressing value in the transactions that are currently going on in your market are quite important, and understanding that value. And then again, linked to that, I think, is this thing of understanding where the value sits in your entity, right? So if somebody is acquiring your business, certainly down the trade sale route, what are they buying? Okay. If the business is just you and it's mainly built around your relationships and you're delivering most of the work that the business performs, how does the business have significant value when you step away and you exit from the business? So reducing the dependency on you, and again putting more emphasis on building a management team behind you that can take on responsibility for day-to-day managing the business and relationships, etc., who will remain in place when you exit, is very much something that should be a journey for most entrepreneurs as they lead up to sale. Again, hopefully, the message here is that we're starting early enough to put these things in place, and again minimize the business's dependency on you as an individual. And again, that's often tied to things, certainly with a trade sale route, around how long you're going to be asked to stick around by a buyer. If a buyer believes that the business doesn't need you to continue, then you're much more likely to receive a shorter amount of earn-out period, if you like, where you're mandated to stay with the business. It shortens your exit timeline post being sold. And a final thing here is a bit of a catch-all, really, to be honest. There's lots of processes about being an entrepreneur and being a business owner within a growing business, that things grow organically and things sort of evolve over time. But just making sure that we do a bit of a spring clean to tidy up our processes, tidy up our contracts, and tidy up our relationships with customers to make sure that we're in the best sellable position, and make sure that we're ready for due diligence that a buyer might do when coming along to look at you. So one of the key first questions that a buyer will ask around understanding your business is, can I see the numbers? Can I see the finances? And again, making sure that we have a clear and slick process for delivering, whether it's monthly or quarterly reporting about how the business is performing, and we understand all of the trends that are ongoing in the business around margin, etc. All of that will drive valuation. And again, just making sure that any contracts, or both with customers and employees, are tidied up and up to date, and current, not expired, as we've seen in a few instances. Normally, it might be a process of just getting them refreshed and getting them brought current. But yeah, this getting sale ready is really sort of a bit of a catch-all point around just making sure the business is set up as well as possible, so that somebody else can come over, take the reins, and carry on from you as you begin to exit the business.
Great. All right. Well, thanks, Dan. That's a really good overview. Now, before we finish and we leave you, I just want to drive home really the key points on today to take away and ponder. And the first being is, know your value and start with valuation. Okay, just like Dan has been discussing. What drives that value is commonly really a successful point for a successful exit. That question of, what are people buying? My route to market, my customers, my IP, my team, my P&L, my balance sheet. What part of my business really is being bought in that process? It's a really interesting thought process. So don't leave valuation as an afterthought. You're likely to only get to sell your business once, so you need to maximize the value from it. Start early and plan ahead. As we just heard, most exit strategies, be it trade sale, MBO, or even EOT, they can take from months, but certainly in the trade sale space, they can take years to execute well. Okay, so planning ahead gives you the most optionality, the most leverage and peace of mind through the process. Okay, and just like Dan was finishing on and linked to this is the get sales ready process. Okay, the getting your house in order, clean financials, up-to-date contracts, capable team, etc., which all leads down to that critical point of reduced dependency on you personally, which is the number one key SME challenge, right? I've built my business, it's all around me, the customers know me, the team knows me, I maybe generate a lot of the original IP in my business. When I remove myself, does the business work without me? Okay, so it's that in business versus on business concept, and reducing the dependency on you increases valuation and certainly increases the likelihood of a successful sale, particularly if you want to go down the trade sale route. So all these make a big difference to value and your process. But ultimately, I think the key message for you is that exiting business, it isn't a single event, it's a process. Hopefully what you're taking from us unpacking this, it's a complicated process often as well, and one that can be shaped on your terms with the right advice and with the right preparation. So if today's sessions has raised any questions, or if you're wondering where your business stands and what a realistic exit path for you looks like, Dan and I would love to talk to you on a one-to-one basis. It's probably not the right environment here to talk about your particular sales. Sales processes are very confidential processes, but we'd love to get some time with you on a call and help start your journey. After this, we'll circulate this deck along with our contact details. So please reach out and we'll get some time booked in together. So thanks again for joining us. We look forward to supporting you on your journey, whenever and if you decide to begin it. Thank you very much.